review. We learned from here asset equal liability plus owner's equity along with four investment drawing revenue expense bad guys. Revenue and expense update first major financial statement as much as we earned and additional investment and drawings update to your equity balance. Then on your balance sheet, just the asset copy to debit side, then liability copy to credit side along with liability plus owner's equity, exactly same as assets. So again, assets equal liability plus owner's equity. Super tool. I can't stress enough how important this tool, super tool, T account is. So remember this one. Increase same side, decrease opposite side. Asset same side, debit side, liability and owner's equity same side, credit side. But drawing and expense opposite direction of their parent side, owner's equity side, so increase with the debit side, opposite. Then you are going to stick. You are going to live in this cycle forever. As long as you live in business environment. Full accounting cycle. Maybe monthly, maybe quarterly, of course, annual, yearly. So business transaction actually create your journal entry based on analyzing asset equal liability plus owner's equity based transaction. Then verify and also you can practice with a super tool. T account cash and the represent same side increase side same side increase side. Journal update your ledger update your trial balance, which include all the accounts name company has along with normal balance amount. So total debit equal like credit. So we call trial balance. Beautiful one page table. So looks like we are ready to have financial statement because income only revenue expenses and then we know how to update each one. So we practice transaction, analyzing transaction, preparation of journal, the start. Then journal update ledger update your trial balance. This is the cycle. This is not memorizing. This is the flow. You need to understand. But some numbers from the first version of trial balance does not represent the real value of each account. Not accurate enough, not correct enough. Like equipment and insurance expense for 1 year policy. So this is not accurate enough. We are not ready. All right. So we decided to analyze again if we have anything already done but not recorded or recorded but not done yet. So first case done already but not updated, we need to increase to correct. Second case, something's already recorded as a total but not done yet, not all of them. So we need decrease to correct prepayment and accruals and prepayment. This process we call adjusting, correcting. So we practice. Once we break to correct, we need to keep the balance by putting exactly same number on the opposite side and determine which account we are going to use. So this is the major practice from chapter 3, adjusting process. So now all of you guys know why we use accumulated depreciation instead of just a deducting from the equipment directly. We want to keep original value at the same time, net book value as of today. So adjusting journal entry from original transaction, correct your income statement account, balance sheet account. Correct your balance sheet account, income statement account. So you know, adjusting journal entry, one from income, one from balance sheet, never ever cash account. Don't forget that. So on adjusted, we made adjusting journal entry, then adjusted trial balance. Now we are good to go for financial statement preparation. Once again, one and only official way to update any numbers on the financial statement, journals. Without having journal entry, you're not able to change any numbers on the financial statement. Okay? So you can't avoid practicing journalizing. Original transaction, adjusting journal, all journals. Without journal, nothing's gonna happen. So this is the cycle. First version, not ready. So adjusting, then now we can start financial statement preparation with correct enough, reliable enough numbers and information. So we practice. This looks like no debit or credit, but you guys already know normal balance of each account, right? Asset side, definitely debit. Credit side, liability, credit. Then capital, credit. And revenue, credit. But drawing, expense, opposite. So debit. Good? Equal trial balance. From adjusted second version of trial balance, start income, owner's equity, and balance sheet. This is the process and flow of accounting cycle. Once again, do not try to memorize, try to understand what we are doing. Transaction, recording, and communicate. We want to communicate with our users by providing the most accurate and reliable financial statement. We must produce, we must generate. Then we done for the past event recording, but as we call full accounting cycle, repeat and repeat and repeat, we need to do something for a coming period. So before we start a new period, some account must be zero because we are going to accumulate the performance. Which what? From income statement. Any accounts on your income statement plus drawings must be clear, closed. As a balance zero before we start new period. So first step of closing out of 4, we close kind of revenue, any revenue, major revenue, and also interest revenue, any name it the revenue, except unearned revenue, guys. Close first, and then second step, expenses, all the expenses. We close the second step. Then we create the income summary. So we close income summary account by updating temporary performance to the permanent account, which is capital account. So we earned profit, then capital increase by putting on credit side. We lost, then capital must be debit side, means decrease the balance of owner's equity. Like drawing the last step, definitely owner took the money out means owner decrease the capital balance. So capital debit opposite of normal, and then drawing we're gonna close by putting exact same amount on opposite of normal balance. Drawing and expense normal balance debit. Good. Hopefully you understand this one. Finally, we have drawing close, revenue close, expense close. So have post closing, the third version of trial balance, which include only what? Permanent account with capital balance. Good. So full accounting cycle, we are going to repeat and repeat every single fiscal year. As I said, first till this, okay, let me clear up. First till this step about the past events, we are going to record and provide a financial statement. Those two, preparation for the coming period, so we can repeat as a cycle, full